Warren Buffett's an amazing man. He says, I could end the deficit in 5 minutes. You just pass a law that says that anytime there is a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election. Might work. Kind of a good idea. I wanted to mention the Nifty 50. We're talking like, the old days, General Motors, which General Motors used to be a mammoth company. It was the cornerstone of our country or our economy. It's just not that way anymore. And Kodak's long gone because of obsolescence, But the Nifty 50 was something that occurred back in around 1968 and actually really broke down around 73, 74. But what happened during that period is people became kind of brainwashed that, there are one decision stocks that you can just buy and never sell. And then the crash came in 73, 74, and everything evaporated. So the lasting lesson is the story of the Nifty 50 became a classic lesson in market history, demonstrating that even exceptional companies can be terrible investments if bought at an excessive price. So the lesson to be learned from the Nifty 50 is don't get hung up on buy and hold because sometimes that just doesn't work. Peter Lynch was real big on chasing 10 baggers, and so am I. I want a 10 bagger. Now, if you think about this for a minute, if you can find a stock that looks like an Apple or a Microsoft or a Tesla, and you can double your money in it, chances are it may go up as much as tenfold. So you don't want to be too quick to let it go. Let your winners run. What you got to look for is the outliers. You get a steady group of stocks, but you got this one outlier here. Outliers are data points that significantly differ from other values in a data set. They can be identified using various methods. I use charts as one of the ways I do it, but you got to realize that you're going to find an outlier not often. It's going to be maybe once, twice, 3 times in your lifetime. It's hard to say. If you get in a roaring bull market, you're going to have the ability to find a lot of outliers, but it's once in a blue moon. It's just not going to happen all the time, and you have to be patient, and you have to stick with it. It's like finding a chicken with teeth, which is kind of crazy, but that's how rare it is. It's rare, but it's worth waiting for. It can fundamentally change your financial situation. The pessimist complains about the wind. The optimist expects it to change. The realist adjusts the sails. So we're seeing a lot of pessimism in the marketplace right now. And we just got to be patient and wait for this thing to really confirm the bull market. Now, this is the S&P 500 compared to the computer staples. Now, the thing to realize about the computer staples is we're talking really basic stuff. Toothpaste, we've talked about this many times in the past. When the institutional investors, or when the investors are this group of stocks, meaning the staples, are dominating the market, it's a real warning. But that's just not happening. Look, it just made a new high. So the ratio between the S&P 500 and the consumer staples just made an all-time new high. We'll look at more of that. Now let's just take a look at the market. Here's the 5 indexes that I think we should be looking at. Here's the NASDAQ. It's holding up. It's consolidating in a very nice basing action. It is holding above the lower moving average, and it's gotten back above the upper moving average. So we're so far so good. The mid caps are actually looking better than the NASDAQ. It's holding above both of the moving averages. Here's the New York Composite, New York Stock Exchange. You'll see that it's holding up as well. So the market's looking somewhat positive. The small caps are actually doing quite well. I mean, they're holding up above both of the moving averages. Now, the small caps tend to be very interest rate sensitive, so we'll look at interest rates here in a minute. S&P 500 actually holding up better than the NASDAQ. So what this all means is the market appears to be broadening out. It's more than just Magnificent 7 stocks. The main thing to understand is the primary trend is up. Here's your 200-day moving average. This is the S&P. Primary trend is up. Here's the NASDAQ. primary trend is up. Don't fight the tape. Don't fight the trend. The trend is positive right now. Now, here's my aggression index, which is the NASDAQ compared to the consumer staples again. It's hitting an all-time new high, not an all-time, well, basically an all-time new high as far as I've been recording this, but it's really looking very positive. But we'll have to see. Interest rates are stable. You're seeing here that the yield on the 5-year Treasury note is actually in a downtrend. And, you know, everybody talks about the Federal Reserve and so forth and so on. I'm really thinking, why do we need the Federal Reserve? Why don't we just have the free market rate? You know, why do we need to have some group of men or women, men and women, determine the interest rate? Let the free market determine the rate. So right now the free market is saying that the 10-year is at 3.68. So, you know, 5-year, the 5-year. And also our indicator is positive. So I'm just saying, you know, I really question the value of having the Federal Reserve. I know that's controversial. But really what's really getting my attention here is the fact that gold is just really skyrocketing. Now, is this because of some type of fear? Is it because the banks are buying all this gold or so forth? I don't really understand it, but I am just looking at the chart and saying, you know, gold is going up. So what does that mean? We'll just have to find out. So anyway, if you have any questions, please let me know.